We're going to talk today about how to start your company, whether it's a side hustle, full-time gig, whatever it is. Um, there are a lot of things to think about and contemplate as you think about how to create your company, what kind of tax structure to create for your company. I want to leave lots of time for questions and I want to keep this very interactive. The only downside to presenting this way is one, I don't get to see my audience, so I don't get any reactions on what you're absorbing, what you're not absorbing, no facial expressions, any of that stuff. However, we do have an active chat, and we're going to stream the chat, and we're going to put up the questions at the bottom of the screen when we get questions. And I want to keep it as interactive as possible. So don't hesitate to ask questions, please. That's why you're here. I want you to get as much out of this as you possibly can. And I'm hoping to answer all your questions. To begin this presentation, I want to say a couple of things. Number one, some of the things that we're going to go over today are that I am not creating an attorney-client representation with you with this. I'm not an attorney. I don't play one on the internet. I'm not a tax expert. I don't play a tax expert on the internet. But I've been doing this for a long time, and I know a lot about tax policy. I love tax policy, actually. I'm a little weird that way. But it's always humorous to watch the ins and outs, the way that our governments try to control our behavior through tax policy. And the tax attorneys make a boatload of money finding ways around it. And that's always been the case and probably always will be the case. But I do want to give you as much information as I can. So all of this content is for recreational and informational purposes. Kind of like you called up a buddy who started a company and say, hey, how'd you do it? What'd you do? I'm pretty fastidious about details, so I believe the information I'm giving you is very, very accurate. But if we get into an area where I'm not sure, I'm going to say, you know what, I'm not sure. But I don't want you to hesitate to ask any questions, because if I don't know, I'll tell you. And if I do know, I'll tell you to the best of my ability and the best of my knowledge.
Welcome everybody. John, do you want to introduce yourself a little bit more with your background?
I always forget to introduce myself, and everybody gives me a hard time. And I did this last time too, so my apologies. My name's John Montague. I've co-founded several companies in my time. I've spent 20 plus years in sales, marketing, and business development, all in software. I consider myself a recovering Microsoft employee. Please don't hold that against me. But I've been doing this a long time. I've started I have either founded or co-founded 5 different companies. I've been a senior executive in 2 public companies and 5 private ones. And I've made every mistake you can possibly make in running a startup. So part of my goal is to share with you my screw-ups so you don't make those mistakes. You may go on to make other mistakes all by yourself, and that's fine. You'll learn from those. But this way I can share with you some of mine. I'm also very fortunate today to have Emma Lowe with me. Emma's kind of keeping the tech in the background running and going to help monitor questions. Emma's from the Toronto area in Canada. She was a founding member of a company called Maxol. She's got was there for 11 years. She's got 15 years experience in technology, running marketing, business development, customer success. She's worn a lot of hats. There's not much that she hasn't done. Please feel free to reach out to her if you want to talk to her specifically. She's very good at what she does. With that, again, I will re-welcome everyone, since now I've done introductions that I screwed up. Thank you, Emma, for pointing that out. And we will again jump right back in. So when you're doing this, I want you to think about forming your team. And to me, your team is your group of advisors. What do I mean by advisors? Well, at some point, you're probably going to want to talk to an attorney. You don't need to, but I strongly recommend it. I also want you to have a tax specialist on your team. I'd recommend a CPA. And as you're doing this for the first time, there's an organization that is part of the Small Business Administration here in the U.S. And I should say that I am going to be talking about how to create a company in the U.S. Canada's laws are different. The UK's laws are different. They are very similar, but they're different. And I am not an expert in the differences because I've never created a company in Canada and I've never created one in the UK. Very briefly, the UK does have something called a limited company, and that's somewhat similar to an LLC. Canada doesn't have an equivalent. They pretty much have partnerships and sole proprietorships and corporations. And there's a distinction I want to make. If you just Google LLC versus S Corp, you're going to get a lot of articles, and they're going to talk about the differences between an LLC and an S Corp. Unfortunately, that's comparing apples to oranges. A lot of people don't understand this, but an LLC, a C Corp, a limited partnership, those are legal entities. And we're going to talk about some of the differences between them. A sub S, often called a sub S Corp, but a sub S is a tax structure. A QSBS, qualified small business structure, is a tax structure. An LLC generally has what's called a pass-through tax structure, although you can choose to be taxed as a sub S. A sole proprietorship can only be taxed as a pass-through. And that just means whatever you earn in the business comes straight through to you in your 1040. So you've got these different legal entities. Okay, one sole proprietorship is really just you yourself as the legal entity. LLC, limited liability corporation, that's a different type of organization. It is not a corporation, it is an organization. In fact, if you go to your companies, your states, every state in the union has something that's generally called division of corporations or something similar. And that's where you would file your articles of organization. In your articles of organization, create your organization if you're structuring as an LLC. You could also structure as a C Corp, very similar paperwork, more complex, less flexible, and you would file that also. Let's talk about those individually and talk about some of the different meanings. So we've got a limited liability corp. You also have an LLP, which is a limited liability partnership. Then you have a C Corp. Those are the main ones. In LLC, which is what the vast majority of the people attending this seminar are probably going to form, there's 8 different types. There's only 2 that really are going to apply for any of us in this room. An LLC, a single member LLC, or a multi-member LLC. After you've created that, and it's very, very quick to create, but it makes sense to sit down with an attorney, and it's not that expensive to do. You're generally going to get a free consultation where you've already made your list of questions, and you can go through that list of questions and get answers to them. And then on an ongoing basis, if you want them to help you, it's generally not that difficult to do. You can also work with organizations like LegalZoom, Zen. I can't remember if it's Zen Corp or Zen something, but there's dozens of businesses that do this nowadays. But you don't need to use them. It literally, it takes less than 15 minutes to create a corporation on most state websites. So the process is simple, especially for an LLC. Let's talk about some of the differences between a sole proprietorship, an LLC, and a C Corp. A sole proprietorship means you just go out and start doing business. Okay, you haven't filed with the state. You're just doing business as John Montague. I generally think that that's a bad idea. Why is that? Part of the reason you want to create an entity like an LLC, single member or multi-member, or an LLP, or a C Corp, is you create a separate legal entity separate from you, the owner or the owners of the organization. Why is that important? Well, that means that the entity is responsible for the debts of the organization, the activities of the organization, and not you. So generally what you're doing is creating a way to protect your personal assets, your house, your property, other assets separated from the business. A sole proprietorship doesn't do that. And that's why I think a sole proprietorship is a bad idea. I think you generally want to have that legal protection and that separation from you and the organization. And you get that with either a single member LLC, a multi-member LLC, an LLP, although it's a little different with an LLP. And LLPs are generally going to be for doctors, accounting firms, attorneys, organizations of that nature generally will select limited liability partnerships. For most of us, it's going to be a single member or multi-member LLC or a C Corp. When does a C Corp make sense? There are times when a C Corp makes sense. Generally, if you want to raise outside money, either venture capital, I'm talking beyond friends and family. Friends and family you can do as an LLC pretty easily. But if you want to raise outside capital, venture capital, or something along those lines, a C Corp makes much more sense. Also, if you want to give stock options to your employees and use that as a form of compensation, that makes sense. For other companies to invest in you, it's easier to do with a C Corp. Now, historically, most people would choose the state of Delaware to incorporate. Why is that? Historically, the state of Delaware has a lot of precedent law already done. And you're going to, if you had to go to court, it's generally going to go to the state of Delaware Chancery Court that has done this for a long time. And it's a very business-friendly environment. However, that recent case with Elon Musk, where they've rejected his compensation package, is going to possibly change all that. It's going to be very interesting. So much so that I think Tesla is actually going to reincorporate in the state of Texas, because what they did was very surprising. Nobody expected that package to get overturned. The reason was that package was very corporate and shareholder friendly. What do I mean by that? They said that they were outraged at Elon potentially making a really significant amount. My recollection is billions of dollars. But what's interesting is in the short term, he took no compensation and took all the risk that if he didn't meet those milestones, he got nothing. I've never seen a CEO do that in my entire career. It just does not happen. I've heard several venture capitalists, well-known venture capitalists, like Bill Gurley from Benchmark, like Brad Gerstner from Altimeter, say that that's about the most shareholder-friendly agreement they've ever seen, and they would take that deal every single day of the week and twice on Sunday. So it's pretty shocking. That's a very interesting determination. It probably will go up to the Delaware Supreme Court. My prediction is it will get overturned, basically because if it doesn't, it's going to make Delaware a much less friendly place to do business. And a lot of companies, from a liability perspective, are going to have to rethink their incorporation in the state of Delaware. Probably more data than you needed, but it's a fascinating story and it's going to change. So Tesla might actually, I think Tesla has reincorporated in the state of Texas, but I'm not sure if it's done yet. So something interesting to keep your eye on. Okay, back to our story. So again, the most of us, LLC, single member or multi-member. Single member, it's pretty easy. With a single member, should you have an operating agreement? Probably. Why do I say that? You don't absolutely need it. I've had LLCs, single member LLCs without operating agreements, and I've had them with operating agreements. One of the reasons to have an operating agreement is it just formalizes the process more. So for example, if you have a single member LLC and you're lazy about your details, you don't have annual meetings, you don't keep minutes of those meetings, you spend a lot of business expenses and your personal expenses, and you mix them up and you don't keep them separate. If someone were to ever sue you, they might be able to make the case that there's really no difference between you and the LLC. And that's what's called piercing the shield of the organization and going after you personally. And you really don't ever want to do that. Having an operating agreement that clearly defines this stuff from the beginning is one way to make that thing that much stronger, the veil, what's called the shield, that much stronger so that it couldn't be pierced from somebody suing you with a frivolous lawsuit down the road. The reason that's important is, unfortunately, we live in a very litigious society. I wish it weren't so, but it is. And you do want to keep that shield there to protect you and your family and your personal assets separate from the corporate assets. Now, you won't be able to do that in all cases. So for example, let's say you go out to rent office space. If you go out to rent office space, whoever's renting you that space will make you sign a personal guarantee. So you're going to have to personally, with your own assets, guarantee that office space lease. And they will come after you for that money, and they will win that case if you do not honor that lease and pay that lease. So you want to be very careful about signing those leases, making sure you're going to be in business for that long, because a lot of times they want a minimum of 3 years or 5 years or sometimes even longer. Now, in this current economic environment, you've got better negotiation power than you have in a number of years for negotiation lease space. But you still will be responsible for making that lease. So be very, very careful if you choose to go down that path. So I said an LLC is not a corporation. It's not. A C-Corp isn't a corporation. So when you create your company as an LLC, you're not incorporating it. You're just creating a company. And when you go to the state website, that's why they're called articles of organization. Again, very simple to fill out. Here in the state of Florida, it literally took me less than 15 minutes to create Executive Focus. Cost me $125 to file. And then every year, I'm going to have to fill out what's called an annual report. Most states do this, but not all. That annual report, it's cost here in the state of Florida, cost $138.75. What is it? It's a tax. It takes 5 minutes to do. It's a very simple 2-page form. And it's just the state's opportunity to charge me $138.75 to stay in the good graces of the state with my articles of organization and my company. Most states, Arizona, for example, is very inexpensive to file. I think it's $100 or less. And then every year they have no requirement for an annual report, and they have no fee every year. Very, very friendly to creating a company. Can you create a company in any state? Yes, you can. But your default generally is going to be your home state. It's the easiest. It usually makes the most sense. However, if you live in a high tax state, Massachusetts, California, then you want to start to maybe think about incorporating elsewhere as one option. You'd want to work with an attorney, because sometimes you could create a company in the state of Arizona. But if you're doing business in Massachusetts, you might have to create a foreign corporation doing business as in Massachusetts, and they might require you to fill out pay those same fees anyway. So you'd want to get a tax expert or an attorney involved in that situation. But for example, Massachusetts is $500 to create your company and $500 a year. It might be $520. I think it's $500, but it could be $520. But that's a pretty big tax every year. California is even worse. It's $850 to create the company, and there's an ongoing fee every year or every 2 years of I believe the same amount, $850. That again gets to be a pretty big tax to fill out every year on top of your business and doing business. However, California, I would state, California has what's called has very high state income taxes. And the California Franchise Tax Board, the organization that imposes those taxes and collects those taxes, is a rather aggressive organization. And so let's say you had a second home or family in Arizona and you created your company there and didn't tell California, you might get away with it for a long time. But if they ever did come after you, they're going to get you. So make sure you talk to a qualified tax attorney in the state of California. Either a qualified attorney or a tax specialist or a tax attorney, any different one. The tax attorney probably being the most expensive, the attorney and the CPA probably being somewhat equivalent. But you want to make sure you have your ducks in a row. You can't ignore this stuff. Okay. So in general, if this is your first time creating an LLC, try to keep it simple. Try to keep it in your home state. Florida's easy because there's no state income tax, and the annual fees are pretty reasonable in general. That's one of the reasons to have an operating agreement for a single member LLC. What about a multi-member LLC? I think an operating agreement is required. An operating agreement essentially defines the company and how the company is going to work, who has what ownership, how that ownership interacts. Often when you first start a company, you're probably going to need to lend the company some money because the company just doesn't have any money. So it's got to come from somewhere. So let's say you seed the company with $25,000. Well, I would generally create a loan agreement where I'm going to loan the company $25,000, either at zero interest rate or a nominal interest rate, 5%, 6%, 7%, so that when that company pays me back, I expect to be paid back in the future when the company starts earning money. That's a very clean way to do it. Gives you some assurance that you're going to get paid back, gives you a little bit of income for the time value of the money that the company's holding. But then it's got some money to do some basic marketing, pay for some of those attorney bills, pay for the CPA tax advice, things of that nature. The company could be responsible for those. After you create that company, the multi-member LLC, you want to, well, actually, before you create it, you want to have worked out your operating agreement. Why do you want to have an operating agreement? A lot of multi-member LLCs, they're going to have problems at some point in time where you and your partner or you and your partners are going to have an issue, and you're not going to agree on everything. Somebody's going to get mad, and somebody wants out. It's best. I call this your divorce proceedings. And so you want to think through and define your divorce proceedings before you ever get there. And that way it's clear cut, so that if you have a difference of opinion 1 year down the road, 2 years down the road, 3 years down the road, you've predefined in the operating agreement exactly what happens. Maybe it's as simple with a 2-person multi-member LLC as you flip a coin. You have a predetermined buyout agreement where I buy out you or you buy out me at a predetermined valuation. What might be a predetermined valuation? 1 times revenue. Services companies, generally, that's a good rough thumbnail sketch of what a valuation might be, because the services, let's say you did $150,000 your second or third year. That might be a reasonable valuation for that business, or what an outside party might pay for it, depending on how repeatable those revenues are. And another way to value it is you take those revenues minus the expenses, and you get your EBITDA, your earnings before income taxes, depreciation, and amortization, and you give that a multiple. For a small private business, a good multiple is maybe 2.5 to 3.5 times that EBITDA. Some people will tell you, oh, it needs to be 5, 7, 10 times. That's kind of in the sniffing glue territory for a small business. But 2.5 to 3.5 is a reasonable ballpark what you might pay. So on that 150,000 revenue, let's say you made 75,000 profit, maybe 2.5 times that, 3 times that, depending on how repeatable it is and what your growth trajectory is. But if you predetermine that in a formula and the operating agreement, it just eliminates all the fights. It's already been decided. And if it's a more than multi-member LLC, you should take that into account too. You might have a partner that leaves. You might have a partner who gets sick. You might have a partner whose spouse gets sick and they can't focus on the business anymore. You want to think about all those scenarios, and you can work through them with a good attorney or a good tax specialist to kind of get you an agreement that makes sense for you in that organization. And it's good to have that written, signed, and defined by all parties well before you create the company. Or it doesn't have to be well, it can be the day before, but just so it's all signed. Don't push this stuff down the road where all of a sudden you've created the company and you start getting into fights and arguments about terms in the operating agreement. That's a bad place to be in, because guess what? Now you're not focusing on the business. You really want to have everybody on the same page so that on day one, you're focused on how do we go find revenue. That's the most important thing once you've created a company. The operating agreement should be done in the past. What are some other things you need to think about? So you've created the operating agreement. You've got your single member or multi-member LLC. Next, you need to go find your EIN number, your employer identification number. It's a tax form. You need to be thinking about, how do you want to be taxed? What kind of tax structure do you want to pick? Most of my LLCs have just gone with a tax-through entity where it just comes to me, much like a sole proprietorship. I do a spreadsheet at the end of the year. My revenue's up here on the top line, all my expenses, and how much profit I made. Give that to my CPA, and when they do my taxes, and that's just filled out on a schedule on your 1040. Two of my companies, we elected to be taxed as a sub S. Okay. This is a scenario where it's a more formal structure, more formal than just an LLC, less formal than a C-Corp. What happens with that structure is it's still going to be a pass-through entity, unlike a C-Corp. So that means it comes down to us, but it's a little more formalized where you're going to get what's called a K1. So all the partners get a K1. That K1 defines, what percentage of ownership you had and what percentage of the revenue you got. And then you can do with either organization, an LLC with no sub S election, or an LLC with sub S election, you can decide to optimize your taxes from this perspective. You may want to pay yourself a salary. In a sub S, you have to pay yourself a salary that is considered reasonable for your industry. Okay. Now, if the company's not making any money, you're not paying yourself a salary. But you could, from an accounting perspective, pay it, and then the company would owe it to you later. You don't have to, but you would pay yourself a salary. And then what's interesting then is anything above and beyond that the company makes could be distributed to the partners as dividends in a distribution. The benefit there is if the company's really rocking and it's making over, I believe the amount would be 160,000 in this day and age, you'd have to pay Social Security and Medicare up to that point, but beyond that you wouldn't. So there's a benefit to that from a tax perspective. However, you have to counterweigh that with the cost of setting up the sub S and the ongoing maintenance of a sub S from getting K1s produced every year, because that's going to be an additional fee probably from your tax advisor. So every situation is different. Work with your core advisor team to figure out what's best for you and your situation, because it will vary. With a sub S, if you elect to have treatment as a sub S, which you fill out form, I believe it's 2553 from the IRS website, and there's a form 1120 that's also associated with that, but I think that's the tax form. But to get all the details, if you just Google sub S LLC sub S election IRS, that'll take you right to the forms and the explanations. They're rather cryptic. Let me go through them in a nutshell. For a sub S, a couple of things, you have to meet all the following requirements. Requirement number one, you can only have 100 shareholders. You can only have one class of stock. All of your shareholders have to be American citizens. Let's see, there's something else. All American citizens, no foreign ownership. You must have a board of directors, and when you have your board meetings, you have to have minutes. Now, those last two, I know plenty of people who have elected sub S, never get a board, and never ever get meeting minutes, and never have any problems. Technically, you should, but if it's a small company, it's too expensive to have a board. It's just not that realistic. You should document formal events like lending the company money. If you do have meetings, you should have minutes of those meetings, and you should keep track of that. All of these formalities help you protect that veil that we talked about earlier of separating you as a personal entity from the corporation entity. So for my software company, Novus RX, that we formed in 2010, we did have a sub S. We did not have a board. We had some advisors from different time to time, but we did have board meetings. We kept minutes of those meetings. It is important to follow those details. That's a sub S. A corporation is even more formal. You have to have a board. You have to have minutes, and it is less flexible, but there are some options. One of the benefits is if you really think your company's going to take off, if I were forming a software company today and I thought it was really going to take off, I would strongly consider possibly making it a C-Corp as an election. And then for a tax structure, selecting QSBS, Qualified Small Business Structure. This has been around since about 1992, I believe it was enacted. It's a fantastic structure. It's a little more expensive to start and a little more expensive to maintain, but has huge tax advantages. Has some specific requirements. The company can never have more than $50 million in assets. Has to be around for a minimum of 5 years. But if you were to get acquired after that or go public after that, there are some tremendous tax savings. Absolutely tremendous. Google it if you want, if you're interested in the details. It does get fairly complex. You're going to have to spend some money to get that set up. But it is absolutely worth it if this company is going to grow to a significant size. My definition of a significant size, more than $5 million, less than $50 million, and you're going to be in it for a minimum of 5 years. And don't kid yourself, by the way, it takes 10 years to build a company. Yes, you can shut it down earlier if it's not working, and you should, I made this mistake with Novus RX. It took off. We were really doing well, but we ran into some challenges. A lot of them regulatory in nature. It's healthcare. What it's what you'd expect. But I probably should have shut that company down 4 years before I did. It's very hard to kill your baby. I now believe differently. Try something, try your business, try and get it going in the first 18 months to 24 months. If it's not, maybe it's time to shut it down and do something else. If it is, sometimes you have to have that grit and take it longer, but create your milestones, make sure you're hitting those milestones. If you're not, really start to question the validity of the business and its existence, because it does cost money. Opportunity cost and time get significant. If you quit your job and you're not making that $150,000 a year anymore, well, that's a pretty big opportunity cost to start a company. So think about that. That's why a lot of people try to start their company as a side hustle, do it on evenings and weekends until you're matching or close to matching your current corporate pay. So those are some things to think about different corporate structures and some tax structures. Now, I don't see any questions yet, so I'm shocked. But if you guys have questions, please feel free to put them in. I've gone through the EIN number. I apologize when I'm looking off to the left. That's just my bigger monitor where I can see my slides and what's going on. Let me go a little bit into some brief comments on banking structures and credit cards. So after you've created your company and you've got your EIN, your employer identification number, one of the first things you're going to do is create a bank account for the business. Again, you want to keep it separate from you. When you go see the bank, they're going to be very happy. They're going to open up a bank account for you. You're going to seed it with some money, and they're going to want to give you right away some checks and a new corporate business credit card. Take the checks. You're going to need them. But in my humble opinion, do not decline the opportunity to take that business credit card. I know you want to. It makes you feel cool, like you're in business. It's a real business. You've got a credit card for the business. Sounds great, tastes great, less filling. But the caveat that they don't tell you about is this. That business credit card has much less personal protections than a personal credit card. So what I recommend you do is either go get another personal credit card or use one of the personal credit cards that you have and dedicate that to your business expenses. Because then you get all of those protections you get from fraud on a personal credit card, which are much, much greater than they are in a business credit card. So it's important to keep everything separate from an accounting standpoint, but you get more personal protections as a personal credit card than a business credit card. In fact, you get very little protection as a business credit card from fraud or anything else. So that's an important consideration to think about. Speak to your tax advisor, speak to your attorney, do your homework. But I believe a personal credit card for your business expenses is the way to go. Similar with checks. Business checks are very different than personal checks. You need to keep track of these. You need to keep them locked up in a safe place. Why? I've had a lot of friends over the years that have had checks stolen where an employee got a hold of the checkbook when nobody was around, flipped down 20, 30, 50 checks, stole a couple sheets, went out and wrote checks on them and cashed them. And guess what? Bank says tough luck. That's your business. Those are your checks. You're the one that's responsible for keeping track of them. They will not refund that money. They don't have to. They don't need to. I love banks, but they're not as friendly as you'd think when it's a business. You have to take the responsibility to keep those checks safe, track where they are, track who has access to them. I recommend keeping them in a locked file cabinet at a minimum or a safe. And really, you have access to them, and maybe one other person in the company. If you have a multi-member LLC, sometimes it makes sense to have checks that need two signatures. So you now have a check and balance in the check writing system. It's not just one person that can approve purchases. It's two. I'll give you an example. Southwest Airlines. When Southwest Airlines was started, Herb Kelleher, one of the founders, lead founder in Southwest Airlines, he had to approve every expenditure over $1,000 for years. That's how much of a control freak he was. But that was really good for the company because then your expenses don't get out of control. He didn't have his second signature, but he was pretty cheap. And if you have that, it's, you don't run that risk of the expenses getting out of control. And they are. If nobody's tracking who's spending money, you can get out of control really quick. I wouldn't give every member a credit card. One person, and that person's in charge. And then everybody else gets to see the credit card statements, question them, challenge them, and keep track of them. So that's a little bit about your bank account, your checks, and how to protect some of that stuff. So Remy says privacy protection is best in Delaware and Wyoming. Kind of. So a lot of people like to incorporate in Wyoming because in Wyoming, they will not publish your names as the members of the single member LLC or multi-member LLC or corporation. Doesn't stop you from getting sued. So, and I'm anybody who knows me will tell you I'm a bit of a privacy nut. I'm terrified of identity theft. I don't like any public information out there about me. When I started my first LLC, I paid a buddy of mine to be the registered agent. I need to review registered agents. We'll come back to that in a second. So he was the registered agent. What is a registered agent? Every corporation needs to have a registered agent. Every LLC needs to have a registered agent. The purpose of the registered agent is if anybody ever wants to sue you, the main purpose is this is the person that receives notifications on the business. So a lawsuit, this is the person who gets served. I had my buddy do it for a long time, probably 10 years. And then I decided, I didn't need to pay him. And there are third-party companies you can pay to do this. They're happy to do it. I just turned it over and made it to myself to save a couple of bucks. I decided it just wasn't that big of a deal. But that means I'm very fortunate. None of my companies have ever been sued. But if they had, that means somebody comes to me, one of those process servers like you see on TV, and says, you've been served. And that begins that legal process. Some people will tell you that the registered agent has to be in office that's open Monday through Friday, 9 to 5. No, that's nonsense. I don't know about every state in the union. I've never, ever seen that in any of the research that I've done in 20 plus years. So I think that's bunk. But that person does need to check the mail, whatever the mailbox is for the corporation and or the office, the main office of the corporation. And, if they get anything, has to notify all the members that they've been served or, other key notifications. But that's the main one. So there are third-party companies, again, that will do this for you. There are other, sometimes same, but other third-party companies where you're going to get some emails with very official-looking documents. And what they're doing is trying to fool you. For example, to jump on their website, it'll look a lot like a state website, but it's not. So beware that once you file, you're going to get a lot of people sending you emails, direct mails, offers for all kinds of stuff, but one of them is to file your annual report. Be very cautious of this. There are usually 2x, 3x, or 4x what it costs you yourself to go out to the state website and do it yourself. I recommend you just go out and do it yourself. These companies are they're kind of scammy. They're just trying to say, hey, we're going to make it easy for you, but they try to make it look like it's from the state or very official looking documents. And some of the direct mail pieces look pretty good. But be very cautious, be smart, do it yourself. Don't waste your money on having anybody else do those filings for you. It's just not that hard. It takes usually 5 minutes a year and will save you some money. In the state of Florida, 1 year, I forgot to file on time. And the state of Florida is kind of a heavy hand on this particular aspect. They wanted to charge me an extra $400 to file it after I missed the deadline. I called up the state, and it turns out in the state of Florida, and I'm sure other states, there's a loophole. And the people at the Department of State were actually really friendly and told me, they said, don't worry about that. Just wait here till September 30th, and that's the date that they roll over on an annual basis. They said, on that date, just call us up, tell us you forgot, and you want to reinstate. And that fee was only $129 versus the $400. So it was just a different path to accomplish the exact same thing. I just had to wait and make sure I hit that date. And the window was pretty small, but I saved over $300. It was kind of nice. So don't hesitate to check your state if they've got some crazy rules around that. It's like every state bureaucracy. There's a lot of crazy rules, but work with them, be nice. Start with honey, not vinegar. You usually get a lot more help with some of those state bureaucracies. Worth checking out. Okay, we got a couple other questions. In our remote working environments from Michael Tucker, do you recommend keeping your hiring to 1 or 2 states to reduce time and costs of filing in each state? Or is that just considered a cost of business? Michael, this varies dramatically depending on the type of business that you have. There's a big swing right now where a lot of people are hiring foreign nationals to work. So it's a contractual relationship. You don't have to, it's not a full-time employee, or it is a full-time employee, but they're 1099. So, you don't have to worry about payroll taxes. Again, you want to work with a tax advisor to make sure, but you can avoid payroll taxes. Payroll taxes can kill a company. A lot of people don't understand them. If you're going to have employees and you're going to have to pay payroll taxes, make sure you're working with a third-party provider to help you manage that. If you don't want to manage it yourself, you can manage it yourself, but just realize this is one of those things that if you do it wrong, it never goes away until it's paid. So even if you sell your business, or your business were to go bankrupt and somebody just buys the assets, payroll liabilities actually survive bankruptcy and go along with it, and sometimes bite the person who buys your company. So rule number 1, if you're ever acquiring a company, you always want to buy the assets, not the company. You're just buying the assets of the company so you don't get any of the liabilities. But payroll is one of those liabilities that will survive and you would still have to pay. And sometimes you have to go to the jurisdiction where the company that you're buying the assets from existed and go down and talk to them to make sure that there's no liabilities. So that's a key one. But again, a lot of times when you hire employees in other states, it does raise your expenses significantly because every state has different rules. In a couple of the LLCs where we've had employees in multiple states, it can become a very quick headache with a lot of costs to meet the obligations that each states have on payroll, benefits in general, workman's comp. All these different things vary state by state, and you start to multiply the load. So you do want to think about that. What most small businesses will do is work with 1099s because it alleviates most of those burdens. But 1099 contract employees. And again, work with your tax advisor to make sure you're not going to get in any trouble, but that will alleviate a lot of those problems. Another question from Michael. Should the registered agent be an employee's address for each state you operate in, or should you require it to be a separate entity? What happens if you switch agents of an employee or partner leaves? It's pretty easy. If you create a company in different states that you're doing business in, and which you're going to need to do if you have brick and mortar businesses in those states. But if you're just doing a 1099 employee doing business in that state, you don't have to immediately create an entity for that state. You've just got a contractor that's doing work in that state for you. Work with your tax advisor to make sure you're clean, but you're going to be clean in that situation. Where you start to run into a problem in these situations, you start to get big. So, if you're over $1 million, $2 million, $3 million in revenue, $5 million in revenue, that's a different story. That's where you're going to start to get potentially on the eyes of those state organizations that you're making money. But if you're not corporate in that state, it's less so. Every state wants you to incorporate in that state because it's a money resource for them. It's essentially a tax for them, and they like that. But you don't have to when you're small. You've just got an employee doing work in that state. And if it becomes a full-time employee, things change. Please check with your tax advisor in that state to make sure you're not going to get into trouble. But if it's a 1099 employee, a contract employee, you're fine. It keeps things very, very simple in those early days. If you wanted brick and mortar in every one of those states, different story. Then you're going to want to create a legal entity in those states. You have to create a legal entity in those states. And the registered agent could easily be that person that's there. Person quits, you hire a new person. All you do is go out and make a change on your state form. You can do that anytime that you want. You've got a new registered agent. No harm, no foul, pretty straightforward, doesn't take very long at all. Usually doesn't cost anything, but again, this will vary state by state. All right, we're at 12:45. We've got 15 minutes left. I've talked through most of the considerations about creating the entity, most of the considerations around the tax implications of creating that entity, some of the things you need to think about in creating the bank account, credit cards, and checks, employee identification number, working with the IRS, working with your tax advisors and an attorney. What other questions might you have? Please feel free to put them in the chat and we'll hit them. All right. Well, I'm going to go ahead and start to wrap. I'm going to leave the chat up for a bit. If anybody wants to add some questions, I'd be happy to answer them. But I'm going to give you guys 14 minutes back to your lunch hour, your day. Please, if anybody wants a copy of the slides, there is a resource page after this with several articles about LLCs and corporation entity structures, as well as sub S, QSBS tax structures for those legal entities. And I'm happy to give anybody a copy of the slides. We will also have a recording this that will live most likely on my YouTube channel. If you want to rewatch it, just send me an email, john@executivefocus.io. That's John, JOHN, at all one word, executivefocus.io. And I'll be happy to send you the slide deck and a link to the recording. And please give me some feedback. Tell me what you don't like. Tell me what you'd like me to go deeper on. Tell me what other topics you have. We're toying around with some other topics. I do a lot of investing. We're toying around with some investing topics, how to think about your portfolio, sales, marketing, business development, product market fit. I've been doing this stuff for a long time, and I'm happy to share the good, the bad, and the ugly that I've done, again, so that you don't make those same mistakes. Good luck, good hunting, good selling. If you've got a personal matter that you want to talk about a little bit more, feel free to hit my website and set up a meeting with me to discuss. And I thank you very much for attending today, and I look forward to further presentations in the future. Thank you very much.